Dear investor, Edelweiss Private Wealth Management is pleased to present you the latest issue of Investment Strategy Report for March 2019. Let's take a look at key highlights of February 2019. Shutdown in the US may have led to a permanent loss of $3 billion to US GDP, according to estimates by the Congressional Budget Office. Imposition of emergency by the Trump administration for the border wall issue may create further uncertainty. Dovish stance by majority of members of the Federal Open Market Committee, as seen in the FOMC minutes, may aid emerging markets in the year ahead by easing the worldwide dollar liquidity situation. India GDP growth moderated to 6.6% in Q3 financial year 19 from a downwardly revised growth of 7% for Q2 financial year 19. Headline inflation in India continued its downward trajectory and came in at 2.1% year-on-year in January. Even core inflation came down to 5.4% year-on-year. Post touching a low of $51.5, Brent crude has bounced back to close to $65. Crude, however, has come down from $70 to $80 levels through last year, which could lower averages and benefit the fiscal deficit situation. We expect financial year 19 Nifty EPS to be 503, which implies a 14% growth over financial year 18 EPS of 443. Correction in small cap and mid cap indices are not commensurate with their fundamental performance. Sustained momentum in non-food bank credit and populist measures regarding certain sectors in the recently presented interim budget should provide sector-specific opportunities. We are optimistic on equities. We advise investors to focus on specific bottom-up opportunities as the broader market has shown strength even amidst recent geopolitical tensions. Improving macroeconomic parameters may open up opportunities in the mid and small cap space. India government 10-year bond yields have hardened approximately 10 basis points in the month of February and currently trade at around 7.41%. Infusion of liquidity continues with 37,500 crore rupees worth of OMO purchases being done for Feb 19. With higher gross market borrowing in the last 2 months of the fiscal and higher target for financial year 20, GSEC yields continue to be sticky. With CPI inflation at 2.1% and expectation of low inflation going ahead as well, RBI may cut benchmark rates further going ahead. This may ease yields to some extent. Corporate bond spreads continue to rise due to high risk aversion and continued liquidity stress. 5-year AAA corporate bond spreads trade at 129 basis points currently compared to historical average of 80 basis points. We recommend investors to focus on hold-to-maturity solutions to take advantage of wide corporate bond spreads. It is advisable to maintain low duration in the portfolio and avoid rate-sensitive allocations.